We have another special guest in our studios, Manishi Raychaudhuri, Asia Pacific Equity Strategist at BNP Paribas, is visiting Mumbai, and he thought, why not stop by the ET Now studios, which we're very glad that you did. Thanks very much for taking the time out.
My pleasure entirely.
Happy New Year, and do you think this is going to be a happy New Year in terms of returns?
Compared to 2018, we think definitely. 2018 was a disastrous year in many respects, and predominantly the driving factors were the continuous rate hikes by the Fed, which obviously squeezed out liquidity from emerging markets as a whole. Which a consequence of the Fed policy stance was a continuous appreciation of the US dollar, which obviously is not a great scenario for emerging markets. We think that we have possibly entered a period of global synchronized slowdown, but at the same time, it's not an economic collapse. So, for example, compared to a 3 to 3.2% GDP growth in the United States in 2018, we think it'll be about 2.3 to 2.4% this year. But the important driver for emerging markets is the potential for US dollar to moderate. We think that in 2019, US dollar is likely to moderate against most of the developed market currencies, and the emerging market currencies are likely to stay stable, which is actually quite a favorable scenario for flows coming back into emerging markets. We think that's likely to materialize possibly from the second quarter. Maybe, it's likely to gather steam in the second half of the year. So the second half of the year in general for Asia is likely to be a lot better, and that's why we have called it a tale of two halves.
And that in some sense has already played out in 2018 also, right? When we're talking about the S&P 500 or Shanghai already in bear market territory, just index pattern wise. The Nifty and I guess Brazil are the only markets which have actually outperformed. Right. So you are saying that you see accentuated outperformance for emerging markets like us as opposed to US?
I would think that yes, in 2019, emerging markets, particularly the Asian emerging markets, should outperform the developed markets. Part of the reason is this whole argument about flows coming back into this part of the world. And second, we must also understand that emerging market equities are a lot cheaper than they used to be. Over past 1 year to 15 months, I think valuations have declined almost about 20% or so. In most of the Asian markets, price earnings or price to book multiples are at a discount to the long-term averages, in some cases even at one standard deviation discount, which is quite significant. I think India is not yet in that club, but if you look at the North Asian markets, they're very cheap, particularly in comparison to the return on equity that they're likely to generate going forward.
Okay. But if you're looking at India's position among EMs, do you think the election will be a boon or a bane for returns in investors this year?
Well, I mean, it would obviously depend on the outcome, which we don't know yet. But at least in the run-up to the elections, there would be continuous news flow. And as we know, that elections tend to be a volatile event in the context of India. So we think that, the first half volatility as a consequence of these factors is likely to continue. In the second half, it'll possibly be more stable as the market comes to a conclusion about the kind of economic policies that the new government is likely to carry through.
No, but if I were to do a scenario analysis, you have the high probable scenarios are the new government coming back with an absolute majority, or they coming back with allies. Okay, so 220 for the BJP plus allies, right? Which are the probable scenarios or much talked about scenarios currently? The one that can shock the markets or perhaps hit the markets hard in terms of a market impact would be a third front or something less than 200 for the BJP, right?
That's right.
So in that light, what is it that you anticipate India to do? Because I think in the first two scenarios, India will be okay.
I think it would be okay. Now, in the third scenario, in the third possibility that you paint, we would really have to watch out what the government says in terms of continuation of their existing economic policies. Because in that kind of a situation, I kind of agree with you that the market would be apprehensive about the kind of, economic policies that would be followed. In particular, if you look at the present government's policies, there were possibly two broad trends or common threads you could talk about. The first was a thrust towards the formalization of economy, and the second was an attempt, I would call it an attempt at this stage, towards fiscal stabilization or fiscal balancing. This year it may not really play out, because of the pressure on farm loan waivers, etc., etc. We may not have that fiscal balance this year. But in general, these two were the broad policy thrusts of the present government. And I think the market would be looking at whether these two trends are continuing going forward, and whether one particular step that was missing from the present government, which is public sector divestment of public sector companies, which we hoped around the beginning of, when this government took over, but it really didn't materialize over the past couple of years. I think that is the other thing that we would have to watch out for.
Okay. So where would you say the outperformance and underperformance could be, assuming that the market does hold through and we manage to sail through and wade over the big event, which is the election?
Right.
What do you think should be the tactical sectoral approach?
Of course. So across Asia, we are recommending 2 or 3 notable themes, and many of these kind of percolate down to the Indian market as well. First, we think domestic consumption across this region is likely to stay stable, notwithstanding the negative news flow that we are seeing currently from China. I'm saying this because if you look at the global economic trend, employment data is very robust, wage growth in the developed markets are strong. Even in this part of the world, in Southeast Asia, in India, in China, disposable incomes are still growing at anywhere between 8 to 10%, in some parts in double digits. That's a very encouraging trend. So I think domestic consumption, particularly consumer discretionaries, in the Indian context it includes the autos as well. That would be a sector to watch out for. That is one sector we are overweight on. Second, we think in the context of India, and this is not just a 2019 story, but over the much longer term, the private sector banks are continuously gaining market share, and they would continue to do so. Particularly those private sector banks which are focused on retail lending more than corporate lending, they are likely to be the gainers in this context. Third, I think, and this pertains more to India, I think even on the technology side, we continue to be favorable towards the IT service companies. They had a massive tailwind in terms of the currency depreciation in 2018, which may not be so in 2019. But we think that if American spending in general, the consumption environment and the business spending remains intact, that's another sector that could do well.
But why autos? Because there's been a marked slowdown that you've seen in the monthly sales numbers.
Right.
And in all likelihood that will reflect in earnings too, right? And stocks have fallen quite a fair bit.
Yes, it would, possibly in the short term.
So you think it's worth buying this decline?
I would rather think that, it would be prudent to buy this decline.
Okay. Wise words. Thank you very much, Manishi, for stopping by and speaking with us this morning. Really appreciate your time.
Thank you very much.